Buyer demand is super, super strong. Our pipeline for properties coming to market is incredibly robust. Like I said, we already have 14 deals on the market right now. We just launched another one today. We're launching another one next week.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hey, welcome back to the show. I'm your host, Todd Dexheimer. With me, excited to have Heidi Addo. Heidi, how are you doing today?
Doing great. Thanks for having me back. Q2, let's go.
Q2, let's go. So Heidi's with Michel Commercial. She's been on the show quite a few times. So we just Q2. We want to talk about what's going on in multifamily, what's going on in the State of the Union here, and dive in. And as everybody knows, I mean, I did a podcast just recently about the tariffs and the volatility of the tariffs and inflation and just the new Trump presidency. And every time a new president comes into the market, there's always volatility. But this, I think, is definitely, most people can agree with me, where this is a lot more because there's a lot of change trying to happen right now, and the markets are reacting. And we saw it, recently, where the stock market just completely looked like it was going to implode. Like it looked like it was going to go down to zero, right? Like, oh my gosh, everybody sell everything right now. The world is ending. And then all of a sudden it starts going back up, and same thing with the 10-year treasury. Man, I wish I had something that we could have locked in on, what was it, Friday, April 7th or whatever it was. Boy, because what was it, Heidi? Do you remember the 10-year was down to like 3.8?
Yeah.
Yeah, it's crazy. And so it's back up today, I think right around 4.4, 4.3, 4.4. But that's created, there's volatility. So with volatility, there's uncertainty. With uncertainty, there's potentially opportunity. And what I feel like, Heidi, and so I want to hear from you on what you see. But what I feel like is when there's a little bit of volatility in the market, it feels like it frees up deals. Not necessarily that you're going to get this smoking hot deal. I don't want to say that. I don't want to pretend like, oh, everybody go on shopping spree right now because the market is crashing. Like, that's just not the case. But I feel like when there's volatility, it shakes some deals loose that maybe weren't going to get shaken loose because everything was going better than planned. And all of a sudden some volatility, people are like, oh, yeah, let's sell. Okay, let's do this finally. So I don't know. That's just my feeling. Maybe I'm wrong. You're the one that sees these deals and talks to sellers and talks to buyers. So I want to hear from you, kind of, what is this volatility? What do you feel like it's done to the market, or maybe will be doing to the market, especially if we continue to see volatility over the next, call it 6 months or so?
Yeah. So I'm multifamily expert. I'm an expert in that, not the expert in all the other things.
Yeah. So let's talk specifically multifamily for sure.
Yeah. So for multifamily, Todd, you're right. Rates dropped. So if we're just talking multifamily, rates dropping is great for multifamily. They dropped. Well, now we're back up to where it was. And for Q1, it's been pretty stable, except for this drop. Now, if things drop, that's much better situation than when things rise. The unpredictability of things rising really changes pricing. It changes being able to do deals or not do deals. When things drop, the deals just get sweeter. So for multifamily, the volatility and the uncertainty is very much there. It's more currently just based on what's been happening. You mentioned tariffs and other things. And once again, I'm not an expert on all those things, but for a developer and people trying to build, those factors are major. For someone who's trying to buy, they're not major factors unless you're doing a huge construction project. But even there, it's not as major a factor right now. So when you're looking at just multifamily buying existing, this uncertainty as rates go down is wonderful. When rates go up, it is a challenge. So when it's a little dip like that, when it really was just a few day dip, we valued probably 4 properties during the dip time frame, just because we're valuing so many properties right now. Well, guess what we did? We updated the value again with a different interest rate. So when we're bringing those properties to market, we're going back to the seller and saying, hey, interest rates really did change. And when you're looking at how an interest rate affects a property, the only the properties of like 10 million or more are really affected by these dramatic quick shifts in the market. It takes smaller deals, more private buyers. They use conventional debt more often. And
Yep.
so the banks are not going to react as quickly as a Freddie or a Fannie lender reacts because their debt is directly related to the 10-year, 7-year treasury. So the uncertainty, yes, it's there. When it goes down, that's just joy. That's not uncertainty, that's joy. But there is uncertainty in the market that is causing things to shift. Your question of like people wanting to get properties on the market, I would say that when things are going well for an extended period of time, then sellers are saying, yes, let's get on the market. If things are not going well for a short period of time, there's actually a pause. Sellers are thinking, well, things might get a little bit better. So right
What
now,
about when somebody has a property on the market? If you're a seller, you got a property on the market, what's the reaction like when things are shaky, when things are odd?
well, if so, when shaky for us means your interest rates are going up. And if you are dependent, like a larger property, we just sold a $34.5 million property. That deal was very dependent on the interest rates. And so at that point, we're all over the board and we're updating the seller based on the interest rates, what they are. The seller, if you're working with us, the seller is very well informed. We don't like surprises.
Yeah.
So you're informed every step of the way. And also, you were informed beforehand. This is a really uncertain time. This new president is bringing some uncertainty. We're hopeful for interest rates to be down. We haven't, the whole story, the whole story. So if you're engaging our firm or another major firm, we don't price, we're not bringing properties to the market to see where pricing will land. We feel very confident in our underwriting. We know how the market's reacting. And so you're not price discovering when you bring a property to the market with us and with other major brokers either.
Yeah. No, that makes sense. Um, you, you've mentioned you actually had a post on LinkedIn today talking about the rents in the Twin Cities and pretty pretty strong rents throughout the entire Twin Cities. Talk a little bit about what's going on in the Twin Cities as far as rent and maybe demand and what's happening in the market.
Yeah, well, I feel today and mostly always because my confidence level is always 1,000. But today I feel like a miracle worker and a mind reader and a market reader. So I'm feeling great. But the reason is because on our last podcast, Todd, I mentioned how Anoka County is going to be a singing county because
Yeah.
there's limited supply. And look at Anoka County coming in
Yeah.
first for rent growth. And that's not going to be the story forever. I've said it before. Anoka
Yeah.
County is not our strongest performing county. It's a supply and demand situation. So we're seeing it right now. They're at 4.5% rent growth, which is really strong. And the
Really
reason
strong.
is there's just not enough supply and the demand continues. And you look at some other places, you look at the least performing neighborhood, it is the west side of St. Paul. And guess where 1,000 units is being developed? Boom, right there. It's a
Yep.
supply and demand. It's just basic economics. And that is a story of the Twin Cities. In the last few years, we had record supply, and that demand has continued. And our quarterly report is actually coming out on Wednesday. But when you take a look at why is there demand in the Twin Cities? Well, we don't have this flood of domestic migration here, but we do actually have a really strong international migration. Plus, people who live in Minnesota usually move back to Minnesota. And
Yep.
so that's kind of the domestic travel. People are not moving here for our weather.
Nope.
And
Nobody's moving here for the weather.
but they're moving here for the jobs as well. And it's
Yeah.
very location dependent. So when you look at some places, like you're talking about the rent growth, when you look at, for example, Maple Grove has had a lot of supply, but they're actually still trailing. That submarket is still showing rent growth right now. It's going to be muted for some more time because they have more supply. But when you look at, I'm just talking about this one suburb in the Twin Cities, Maple Grove, and when you look at their jobs, they have continually more jobs being
Yeah.
added constantly. And that is a driver of wealth. It's a driver of people. And it also is a really great base for any city just to have an incredible job base.
Yeah. Yeah. When you drive down the freeway and you see new development, not single family home development, not apartment development, when you see industrial and commercial development in that city, you know good things are happening. And
Yeah.
that's what you see right now in Maple Grove. I mean, Boston Scientific and so on and so forth. I mean, many names are going into that market. So definitely a good side of the market. Do you think that helps talk about Anoka County? I mean, do you think that helps that kind of general region overall when you see that Maple Grove? I mean, it's a connected, I guess.
I think so. Boston Scientific specifically is going to be really hiring high skilled jobs. So Anoka County is still a slightly less of an income type of county.
Yep.
So I think that what Anoka County is really going to benefit from is all these manufacturing jobs that are right on that corridor as well. And that is a robust part of Anoka County's job makeup. So I would say yes. I think the whole job ecosystem supports each other in that way. But Anoka County's story is very specific to supply and demand.
Talk about we before we hit record, we were talking about just sales price and stability and what's going on in what you're seeing in the market, what you've been seeing for sales prices in general. I know you've made some social media posts on just what's happening in the market and the stability of the market.
Yeah, for sure. So in Q1, let's just talk about Class A sales. And your audience knows what Class A is, but they're
Yep.
newer built properties, usually fully amenitized, in-unit laundry, underground parking, things like that. So we had 5 Class A sales in the Twin Cities in Q1 of 2025. And what we were talking about before we came online here is when you look at their average rents. Now, these are their average asking rents. And when you look at their average asking rents and you compare it to the sale price, you really start to see some stabilization, which is funny because we were talking about uncertainty. And in Q1, the treasury rates were relatively stable, little
Right.
fluctuation, but not major. And the major fluctuations are the challenge. So these little fluctuations, when I'm looking, I'm going to use 2 examples. Now, I know the audience is smart. They're not apples to apples, but they're pretty close within 10 miles of each other, different, a little bit different, but very similar. So there was a ultra luxury property, but in a less desirable submarket, Brooklyn Center, that was called 610 West. Their asking rents are $1,991 per unit. That sold in January at $229,000 per unit. So using that as a basis, that was a rounded number. Then we sold a property in Blaine, and we sold that property closed in February. So we're really talking timeline apples to
Yeah.
apples. And that property had average rents of $1,810. So that's a $180 difference per unit. Price per unit, sale price, $227,000 per unit. So rounded. So you are within $2,000 per unit. And Blaine is a better submarket than Brooklyn Center. And I know the cap rate on our deal, we closed at a 5.5 trailing 3
Hmm.
on actuals. I know the 610 West was 6 cap or greater. So the locations are different. I want to say that. But when you look at the average rents, they're pretty close. So when you look at this in the grand scheme of things, in theory, you can kind of take that average rent and in some cases take a look and you kind of know where your ballpark value will be on a price per unit. And then juxtapose that just to the west. There was another sale in Osseo in February that sold for $214,000 per unit. And those rents were $1,790. And I do know that property had a last minute retrade because rates looked like they were going up. They actually ended up going down. So that buyer really lucked out. But when you kind of look across the plane, those are pretty similar values based
Yeah.
on those average rents. And then you look at some other places in Minneapolis and you see the rents are $500 more. Well, look at their value, $290,000. Well, $500, capitalize
Right.
that. I mean, you can just kind of see, once again, it's not exactly apples to apples, but it's the best we can get. And you can really see some of those similarities starting to take shape.
Yeah, which shows you that there's stability in the pricing. We you can look at the numbers, you can look at the financials, and you can figure out, okay, this is about what it's going to trade for. We're going to be really close. Where over the last, since, yeah, I mean, 2023, 2024, there was just a lot of pricing discovery happening those years. And I know our underwriting was showing much different pricing than it was just a few years ago when interest rates were, a fraction of what they were, half of what they were. So I think everybody was trying to price discover. It feels like now we are getting to a level where we're starting to see like this is where pricing is going to end up.
Yep.
Does that feel right?
That's for sure. And the other thing is when a broker is bringing a property to market, we are expecting not to have price discovery occur in our deals. So I think we have 14 deals on the market right now.
Hmm.
And when you're looking at all those deals, we are definitely landing within our pricing guidance. All the townhomes that we brought to market actually have exceeded our guidance, which
Oh,
is
wow.
really just a testament to townhomes
Yeah.
because our guidance is strong. If
Yeah.
my commercial is bringing a property to market, it's going to be strong. And so townhomes are a different story. But when when we were bringing properties to market, when rates were all over the place, we were landing below our guidance, truthfully. And that's because interest rates do affect pricing.
Yep.
And when you can't predict it, it's hard. I mean, you just can't.
Yep. Well, uncertainty, just you have to underwrite for it. When nobody knows what's going to happen, you kind of have to underwrite for that uncertainty. So that creates definitely more pricing discovery. What you talk about of course we got the B and C class still. What are you seeing of those properties and of what you guys are looking at potentially bringing on the market, have been bringing on the market lately? What type of property is selling the easiest, the quickest? What are you seeing the most? What properties are struggling to sell? Give me a breakdown of what's going on.
Yeah. Well, it's definitely the flight to quality. So those townhome properties. So we brought a full townhome portfolio to market. We're bringing more townhomes to market as the year progresses. And I think we had over 30 tours of these townhomes.
Oh,
So
wow.
those townhomes are really drawing the most. So it's that flight to quality. Townhomes often attract a really strong resident base that stays there a long time and really makes it their
Yeah.
home.
Yeah.
So also we're looking at properties that were built newer than 1990. They're getting a lot of traction. And when you're talking about larger properties, we brought a portfolio to market that was a 60s property portfolio and 236 units. That's a large portfolio. And the feedback, we had many offers. It's under contract. It's all going well. But the feedback was, from institutional investors, we're looking at newer product now.
Hmm.
And so there is an opportunity for older product at larger scale older product because there is a swath of the market because insurance rates are higher, repairs and maintenance are higher, just some factors like that. In-unit laundry is the number one amenity. And in these 60 buildings, if you've got concrete between the floors, you can't do in-unit laundry, or you can't vent very easily for that. So there's just some challenges there, but there's opportunity there. The buyer who's buying it, not afraid of 60s product, they're kind of like, bring it on. If everyone
Yeah.
else is out, we're in.
Yeah.
And you're right. Just if you underwrite for some more repairs and maintenance. Todd, I know I sold you a property recently that has pinhole leaks. Well, it sounds like your team underwrote for redoing some of the plumbing. Those are the things you have to be aware of. Those are the things that experts know that sometimes novices don't realize. But here's the thing about a great broker like myself and others is that we are front loading people. And that's part of the uncertainty that a broker right now is trying to remove for a buyer. If you're working with a major broker, we're front loading you. So we brought a portfolio to market. You could see by looking at it, if you know buildings, those roofs are going to need to be replaced pretty soon. So we got out, we got 2 bids for roof replacements. We put them in a virtual deal room and we said, you better underwrite for this because there is no retrading happening. You know everything about this property and there's no surprises because a broker's job is to make a deal between the seller and the buyer, and both parties need to be happy with that for it to be a good deal.
Yep.
And so to front load everybody, to be able to allow your team to underwrite the deal, it's best for you, it's best for the seller, it gets the deal done, and that's the goal.
Yeah. Yeah. If you're going to buy a 60s vintage building, you need to understand what you're doing. Cause like you said, those repairs and maintenance and insurance costs, they're significant. Uh, I, I, a lot of people don't realize it, but like, if you just think about it, like think about the year 2000, that 60s property, you saying, oh, I'm going to buy a 60s property today is like in 2000 saying I'm going to buy a 1935 property. Right.
Wow.
Isn't that
Yeah.
crazy? And it's
That,
just like 2000 wasn't that long ago. Well, yeah, it was. It was 25 years ago now. And so you're even a 2000 built property, that's 25-year-old property. Um, that's a bit of an age. So you have to be aware. So are you seeing any are you seeing a lot of value add type properties? Are those attractive right now to buyers and are sellers, I guess, selling value add type deals as well? Or is that kind of pushed to the side for the most part?
so let's start with the seller. The seller who's buying a value add deal is not thinking, oh, my property's value add deal. The broker
Mm,
puts the value add deal on it.
yeah,
The
yeah.
seller is someone who's owned that property for a long time. So
Yes.
the seller is wanting to get out because they're retiring. It's getting hard. If you've got a value add deal, what value add means is someone else is going to come and rehab it, or rehab's the wrong word, renovate it. And they're going to rip out everything and they're going to make it better for a higher price per month rent, and then also just a higher echelon of resident. And so the person who is selling that is usually tired. That's the main reason. So the answer is yes, people are selling value add deals. They are getting financed, and actually it's easier to finance deals now than it has been in the past, just because lenders are more able and willing to transact. And
Who are you seeing as the lender financing these types of deals?
in the Twin Cities, it's very specific, of
Yeah.
course, based on, but Bridgewater Bank, shout out to them. They have done the last 3 value add deals that
So local banks.
local. Yeah,
Yeah.
yeah. They got a big shout out on your platform. Okay.
Yeah.
But
Well, the deal that we bought was Bridgewater Bank gave us some good terms, and so we had several other local banks that gave us really good terms. We went with Bridgewater because they're a known entity to us. We've done a lot of business with them, and so it made sense. But yeah, local banks have been really good in the Twin Cities, at least.
for sure. And then, so take a look at the buyer now. Value add is super attractive to the buyer. Here is the kicker though. Value add can mean a few things. Is it a value add where you're just going to redo the units and do some common areas? Or is this a repositioning where you need to fill in the pool? You need to fix the slanting hallways. Is this starting to sound familiar to you, Todd? You got to remove something. You got to tear something down. That's a repositioning. That is beyond a value add. And
Yep.
those are the most challenging to do. Those have a lot of interest on the front end. But when it comes down to it, they're so expensive. People are putting $4 million into these properties. And that is really challenging. So those on the front end have a lot of interest. On the back end, only a few people can actually get them done. Now, the value add where you're just renovating a property, tons of interest. Like I said,
Yeah.
we brought a value add portfolio. We had 43 tours.
Wow. And out of 43 tours, how many offers do you usually get?
We had 16 offers.
That's a lot.
Yeah. Yep.
Yeah. Wow. Um, I'm sure it'd be interesting to, I don't know if you guys do a breakdown of how many of those showings are just tire kickers where you're like, these, these guys or gals had no real interest in buying this. They're just kicking tires. They want, they're wannabes. How many are, really serious and going through their due diligence and underwriting, and how many are just out to hang out? And
Well, Todd, I can tell you because we provide sellers with a full breakdown of every person touring. So we have a
okay,
full file with every person touring, and we don't usually have tire kickers because
you don't. Okay.
the Twin Cities is a big, small town.
Yeah.
And one thing, so when we have someone, well, usually you get a tire kicker on a smaller property too,
Mhm.
like a $1 million, because a tire kicker on a $5 million, you got to have $1 million. And if you don't have $1 million, you're really not the person for it.
Yeah.
And you have $1 million, we know you.
Yeah.
And so it's a big, small town. So if it's a 1 million, we don't do a ton of $1 million deals just because our deals are larger
Yeah.
usually.
Yeah. Yeah.
If you got a $1 million deal in maybe a less desirable location, you have a lot of people who have a duplex. Nothing wrong with someone who owns a duplex, but they want to trade out of that duplex. They don't actually have the cash. That's where you get a lot of newer investors. But when you're dealing in mostly what we deal with, larger properties, you don't get people that don't have the funds. You got the funds. And if we don't know you, we may ask for information about you to have you tour.
What would you say to somebody that tours a property? They like it, but they're pretty far off the strike price. What would you say to that person? Should they make an offer even though it's going to be low? Should they not insult you or the seller and not make the offer? Like, what's the strategy there? What do you suggest?
Talk to the broker. It's going to depend
Yeah.
on the property, the seller, the offer, and how much traction we're already getting. So, for example, I brought a property to market. I had 43 tours, and people are saying, yeah, I'm going to make an offer. So then for me, when someone says, I'm 20% below your guidance, should I make an offer? In that situation, my thought would be, so I know what 20% is below. I'm thinking about it. I know the other interest. I'm going to say, you know what? This seller has a lot more to sell. We're bringing more things to market for them. I think at this time, it sounds like maybe this is not your top interested property. Let's not make an offer this time.
Yeah.
However, if I'm selling a property in East St. Paul is difficult right now, even at a lower price per unit, and you just have a limited buyer pool. That's the main challenge. So in that location, I only had 6 tours, and I only have one person that I trust can get it across the finish line because there's just not a wide berth of qualified buyers at that location. And they're saying, hey, you're 20% below guidance. I might say, you know what, make an offer. The seller gets to decide. And
Yep.
so at least
That
the
makes
seller
sense.
has everything on the table, but if you already have 16 offers and you have a super, super low ball offer, the seller is kind of like, whatever. So it depends.
Yeah. Yeah. So I mean, bottom line is talk to the broker. Figure out if does it make sense to write the offer. You still might not get it, but I have found that sometimes making the offer is something the broker actually appreciates at times, right? But again, it's talking to the broker and saying, hey, does it make sense? We are whatever 15% off, 20% off of guidance. Will this help you out? Like, does this make any sense for us to do? Um, and sometimes the answer is yes. And so, yeah.
And
Um,
I second that, Todd. Usually we welcome all offers because
yeah.
our goal is to show the seller the market, and the market is vast. Everyone views properties differently. Some people might pay more because they live closer to the property. Other people are
Mm,
like, I'm interested if I can get it at this price. So our goal as brokers to bring the market. So getting all the offers to them, like that is it's usually a yes. You want to make an offer? Yes. Go ahead.
yeah. I had a really interesting conversation with another operator, and we syndicate our properties with Endurus, and they don't. They have their own family money, and we were talking about it, and we were talking about both of our numbers are we were talking about a few deals that we both offered on, and we're pretty similar in our approach, and we laughed because this person said, well, I always thought syndicators like you were driving up the prices. And I said, I always thought families like you were driving up the prices. We both thought each other was driving up the prices. It's funny that, but yeah, everybody's got a different criteria. My thought was, well, if you got your own family money, you just pay more because you don't, it's cash. You just want another property, cash flow, blah, blah, blah. And the same thing with their point of view on a syndicator. So it's always interesting to hear why people are buying properties for 20%, 30% more than what you're willing to pay. But there's typically a reason why it works for them.
Mhm. Yeah, usually economies of scale is also that reason. If they
Yeah.
own next door, then all of their costs are much less just because you can have one person doing it all, managing it all
Yeah.
as one, things like that.
Yeah. And that's a perfect example. We bought a property earlier in 2024, and economies of scale made a lot of sense. We already had a property directly across the street, and it made a lot of sense for us to hitch on a new property to give us 158 units versus just 54. So, um, Heidi, do you see everybody keeps talking about multifamily distress specifically? And we're going to see multifamily distress. And it's been, I don't know, people have been talking about it for 2 years now, right? Um, and I've been wondering, is it coming? Is it coming? Is it coming? You talk to a lot of sellers, you talk to a lot of owners. Are you seeing distressed owners in the market? And do you feel like in 2025, 2026, sometime and then call it in the near future, call it the next year or two, do you see distressed multifamily hitting the market? And we'll talk Twin Cities specifically because that's what you deal with.
So let's categorize it as stressed owners and de-stressed like situations. So there are quite a few owners in with stress right now because your debt service coverage is not meeting, and or your debt is coming due, and to recapitalize that debt is a loss in
Yeah.
some regard, whether it's
Yeah.
cash flow or you have to bring money to the table or something like that. So people are talking to us. They are stressed about these factors, and debt service coverage. So we'll just talk about one example is if your debt service coverage is not meeting, a bank can take that back. Now, does a bank want to? That's kind of the question. Yeah, they
Yeah.
don't usually want to, but we worked with an owner that their bank is, supposedly not playing around, which I understand. So they need to figure out what to do, and bring it to market doesn't make sense. You can't sell it for what you owe, so that doesn't make sense. So that is something that's a smaller deal that I'm talking about. Now, larger multifamily deals, the ones that are being sold right now are being sold Class A properties. Let's just talk about Class A properties. They're being sold because their debt is due, period, or it's getting recycled. So any property that's on the market that's Class A, which is why we had 5 deals sell. Well, we sold a deal. Our seller was not stressed in the way like the bank is coming for it, but
Yeah.
he was stress is not the word. He wanted to recycle that capital because he's building somewhere else.
Sure.
And he needs to recycle his capital. He needs to recycle his staff. They need to move on to the next deal, the next building they're building.
He was time
So
constrained.
exactly. And so that is the stress that is happening. And we're mostly seeing it with those new builds. And the reason we're seeing with the new builds is because they built in 2021,
Yeah.
maybe 22, and they had 3 to 5 year debt on that with construction interest only. Well, now it's getting reset. They pro forma'd, which in hindsight, it's foolish, but at the time, it felt like the market was never going to change.
Yep.
So when you pro forma'd at an exit cap of a 5 or a 4 exit cap, that doesn't make sense. And when it only works with those numbers, that's a challenge. So there is stress in the market. You're seeing it most with Class A. If a property came to market, it's because of one of those factors. So it's different than how people were hoping. They were hoping for a Great Recession,
Yeah.
where
They're hoping for fire sale.
exactly. And I don't think we're going to see that in the Twin Cities. The Twin Cities is too conservative fiduciarily. Like people are not usually incredibly levered. There are people out there, trust me on that, but it's different than maybe the Wild there's other markets that are like way more risk open to way higher risk,
Yep.
and they're getting blown out of here and it's not going well for them. Well, here in the Twin Cities, people took risks, but they were a little bit less. And if any property is brought to market brand new, it's for a stressed reason. That's a broad brush. That's not always the way it is, but like broad brush, Class A, you're in some type of time bound.
Yeah. Yeah, that makes sense. And that's why they're transacting too. That these deals have to get done. Are you seeing sellers losing a significant amount of money, or are you seeing it's maybe break even or not hitting pro formas?
Well, the Maverick sold, that's a North Loop property, that sold for what is significant because in multifamily in the Twin Cities, Maverick sold for at least a $10 million loss. I think it might have been even greater than that. And we've seen other downtown properties all sell for losses. So they all sold for losses.
Hmm.
And then the Rafter, which is in Northeast, it sold for like effective a $400,000 loss, which really they should feel great about not losing their skin, but that's
Yeah.
still a loss.
Yeah.
So the downtown properties, if you sold downtown property, you lost.
You
Now
lost.
that's multifamily. Now there was I'm just going to jump here because it's just very interesting.
The Office.
The Office.
Oh my gosh.
That was like how much of a loss? $194 million loss?
Yeah, it was, yeah, right. It was somewhere around there. It was around a $200 million purchase and a $6 million sale. Does that sound right?
That sounds right to me.
Oh, it's
So
crazy.
that is crazy. And we're not
But
seeing,
by that time, like, it doesn't matter how much it is. Like, you lost money, you lost. Like, you just,
oh, you're done.
whether it was a $200 million loss or a $50 million loss, it's a big loss.
Huge. Huge.
Uh,
Yep.
Yeah, that's a different story. We aren't seeing that in multifamily. As much as some people were hoping we would start to see some fire sale properties, I just haven't seen it. I've known about some very distressed owners, and their properties are still going for um, decent prices. I mean, prices that we aren't even able to pay at, then they're in a distressed situation. So.
Yeah. And a lot of people who are in distress right now, they're in distress because maybe their lender is putting them in distress, or they're just like, man, this is not cash flowing for me. And that cash flow zero is happening more than you want to know.
Yeah.
And people are taking personal hits. They had this pro forma that they were investors would get something. Well, here's the sunshine is you're covering your debt. So you're covering your mortgage and the property is running, it's fully occupied. I think that could be a silver lining. Even if you're cash flowing zero, at least you have your building, it's under control. There may be hope for that to cash flow again.
Yeah.
Um, Cash flow zero is no one's goal, but at least you're not losing the property.
Yeah. Yeah. All right, Heidi, we'll wrap up here, but I just want to know why you are excited. What are you excited about in 2025? What do you maybe see as challenges over the next 6-12 months?
Yeah. Well, pricing is on the rise, so that I'm excited about that. Buyer demand is super, super strong. Our pipeline for properties coming to market is incredibly robust. Like I said, we already have 14 deals on the market right now. We just launched another one today. We're launching another one next week,
Hmm.
and it's kind of that like drip for forever. And so we're excited about that. Some challenges, we're definitely going to continue to have urban challenges. And the policy uncertainty in our market is strong. We know with rent control in St. Paul and Minneapolis talking about that too. Both markets have really limited buyer interest. And so that's a challenge, which means pricing continues to drop. I just valued another property at 60,000 a unit.
Oh,
And this
wow.
property, the seller did not sell it when they should have sold it. We valued this 3 years ago. They wanted a number. We told them the market's not going to bear that number. Another broker took it to market, and of course, it did not trade. Well, now we are at least 30% lower than that
Hmm.
value that they got.
Wow.
And that's a $60,000 value. It's like, we're like, that might be the best you can get right now. And it's not the most desirable location though.
Yeah.
So that is definitely going to be the challenge in our market. But what I'm also looking forward to is continued rent growth. It's a supply and demand situation. So the continual time that we have limited supply and our demand continues to be robust, we're going to be seeing that emerging rent growth, and we're going to see decrease in vacancy. So for someone who's got existing properties or anyone who's still under construction right now, the future is bright. And for those urban locations, I would just say hold in, hold on, hang in there, try to keep your properties fully occupied with a strong resident base. I think right now to expect an increase in rents is unlikely, but if you can keep a strong resident base and keep your rents neutral, I think that's the best you can ask for right now.
Yeah. Yeah, stupid St. Paul. I mean, they've made it harder for us to raise in the Twin Cities in general, just because everybody, when people hear Twin Cities, they're like, oh, but what about rent control? I heard there was rent control in the Twin Cities. No, that's just the city of St. Paul that has rent control. Oh, it doesn't affect, what Champlin, it doesn't affect. No, it's just St. Paul. Promise. Like,
Yes, totally.
stupid St. Paul. I lived in the city. I actually enjoy the city. Unfortunately, there's not good things happening in the city right now. But I really hope that it bounces back because I do like St. Paul a lot. Well, Heidi, any last words for us?
Find me on LinkedIn. I'm super active on social media. Our team's a social media leader in the Twin Cities and always pushing out content and trying to add value. So
Yeah,
thanks for the time, Todd.
yeah, definitely. Yeah, I agree. Connect with Heidi on LinkedIn. You're gonna find good information, just good market data that she's continually posting to keep you up to date. So, Heidi, really appreciate you, and I'm sure we'll talk to you here on the podcast soon.
Looking forward to it. Thanks.
Hey, thanks so much for listening. I appreciate you being a loyal listener. Say, I would love to have you go on to our Facebook page and subscribe. Give us a thumbs up. Go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.